Today, we're diving into a real head-scratcher from the online recruitment giant Boss Zippin. Their latest financial results just dropped, and honestly, they seem to completely contradict themselves. So how in the world can a company's profits absolutely skyrocket while its growth is actually slowing down? Well, let's get into it.
Okay, so here's how we're going to break this all down. We'll start with the paradox that got everyone talking. Then we'll pull back the curtain on the efficiency revolution that's really behind all of this. We'll look at the bull case, the bear case, see how they stack up against the competition, and wrap it all up with the big final question that every investor is asking.
All right, let's set the stage. When Boss Zip-In put out its Q2 earnings, the market was looking at a genuine puzzle. I mean, on the surface, the numbers just didn't seem to make any sense. It created this core paradox that we really need to understand first.
And this, right here, is the central mystery. How is it possible for profits to explode by over 70% when your sales growth is, kind of meh? It feels completely backward, but the answer actually reveals a massive, deliberate strategic shift happening inside the company.
So first, let's talk about the top line, the revenue. It grew by 9.7% compared to last year. Now, let's be clear, that's not bad at all. In fact, it actually beat what analysts were expecting. But for a big tech company like this, it's not exactly the kind of jaw-dropping growth that gets people excited.
But then you see this number, net profit, what they actually get to keep, soared by over 70%. That's not just growth, that is a massive, massive leap. And right there, that's the paradox. Pretty average sales growth, but an incredible surge on the bottom line. So what on earth is going on? The answer, it turns out, is a complete change in philosophy. It looks like Boss Zip-In has pretty much torn up its old playbook. The company made a very conscious, very strategic pivot to a new mantra, smart profitability. And this really is a night and day difference. You see, the old Boss Zip-In was a classic tech growth story. You know the one. Chase revenue, get more users, spend whatever it takes. The new Boss Zip-In? It's a leaner, meaner machine that's laser-focused on squeezing every last drop of profit out of the business it already has. So, how'd they pull it off? Well, the first big move was a pretty significant cut to their workforce. They went from nearly 5,700 employees down to about 4,700. That's a drop of over 16% in just 6 months. Now, this wasn't a sign of trouble, it was a calculated move to get way more efficient. And that one decision had this huge direct ripple effect on the financials. You can see their spending on things like marketing and R&D dropped quite a bit. And the result of all that, their adjusted operating margin hit an incredible all-time high of almost 42%. They were just making way more money from every single dollar that came in the door. This is a textbook example of a super powerful financial concept called operational leverage. Basically, by cutting your fixed costs, like salaries, every new sale you make becomes dramatically more profitable. And it looks like Boss Zip-In just unlocked that power in a huge way. So, what do investors think about this big change? Well, for the optimists, the bulls, they don't see this as a company that's slowing down. Nope. They see it as the start of a much smarter, more sustainable era of growth. This whole bull case really rests on 3 main pillars. First, AI is becoming a massive profit driver for them. They're generating huge chunks of their code with it. Second, they're still totally dominant in key growth areas like small businesses and blue-collar jobs. And third, they've started giving cash back to shareholders with dividends and stock buybacks, which is a huge signal of confidence from management. And it looks like Wall Street is buying it. After this report came out, big players like Citi, Jefferies, and UBS all came out and raised their price targets on the stock. That's a pretty strong vote of confidence in this new efficiency-first strategy. But of course, it's not all sunshine and rainbows. For every bull, there's a bear lurking around the corner. So to get the full picture, we have to look at the risks, the arguments from the more cautious side of the street. So the bears are pointing to 4 main concerns. First off, the stock's valuation is pretty steep. Second, the entire hiring industry is super sensitive to the broader economy. If there's a recession, they'll feel it. Third, there are some questions about their reliance on non-GAAP metrics, which are basically adjusted profit numbers that can sometimes make things look a bit better than they are. And finally, you always have to worry about a giant like Diane deciding to get serious about recruitment. But really, the biggest risk by far is just the price of the stock. As this analysis from Zacks points out, the stock is expensive. It's basically priced for perfection, which means that any little slip-up could cause a pretty big drop. A lot of good news is already baked into the share price. Now, that high valuation we just mentioned, it's often justified by saying a company is the undisputed market leader. So let's take a look. Just how far ahead is Boss Zipin from everyone else in China's online recruitment space?
A quick glance at these numbers tells you pretty much everything you need to know. Just look at the market cap, over $10 billion. Its closest public competitor, Lipin, is worth less than $300 million. It's not even close. In terms of sheer size and value, Boss Zipin is playing a completely different game.
And what it all comes down to is scale. With almost 64 million people using the platform every single month, they've built this incredibly powerful network effect, right? More job seekers bring in more companies, and more companies bring in even more job seekers. It's a cycle that makes it incredibly difficult for anyone else to catch up.
And this all brings us to our final section. The company has pulled off this amazing transformation, but this new identity as a lean, profitable machine means we have to think about valuing it in a whole new way.
Yeah, analysts are starting to call Boss Zipin a GARP stock. It stands for growth at a reasonable price. It's no longer just a speculative bet on future growth. It's a mature, profitable market leader that, by the way, is still growing. But here is the catch. That reasonable price part of the acronym is very much up for debate. Its price-to-earnings ratio, which is a key way to measure how expensive a stock is hovering in a really high range, somewhere between 35 and 45 times its earnings.
Just to quickly break that down, the PE ratio basically tells you how many dollars investors are willing to pay today for every $1 of the company's current profit. A high PE, like this one, means that expectations for future profit growth are very, very high.
And that leaves us with the final critical question. There's really no doubt about it. Boss Zipin has engineered a masterful pivot into a highly profitable powerhouse. But for anyone looking at the stock today, the debate is simple. Has the market already priced in all that success? And is this new super efficient future truly worth that premium price tag?